Good afternoon. Time to have a look at the markets picture. Asian markets pushed higher, even though we did see the Nikkei in Japan bucking the trend there, down about 0.25%. Investors continue to be concerned about the pace of growth, given the fact that we are in a already monetary tightening environment. And the other issue happens to be China's strict lockdown measures and the pressures that it's adding to supply chains. Nonetheless, when we look at the European markets, a bit of a mixed picture at this particular point as those markets try to bounce back following losses. Nonetheless, we are also seeing traders begin to dial back some of the pace of Fed hikes and the expectations around that. But the FOMC minutes that we are expecting a little bit later on will give us some clarity and direction. Nonetheless, to talk to us about some of the dynamics playing out in terms of the markets, we are joined by Carmen Pelwana from ABSA Asset Management. Carmen, thank you so much for your time. Looking at our local markets, we've seen the financials and resources weaker. What's pulling that down?
I think going into this week has definitely been the macro overhang number one. So as you've mentioned, the FOMC meeting minutes are coming out later this evening. So that's also giving some direction. It's been a risk off for the most part. We've seen tech stocks take a big hit, despite China coming in and affording some support. We've seen that was just shrugged off by the market. So we continue to see a negative route on the JSE.
On SENS, we also had a couple of results from some of our listed companies. And let's start off with Tiger Brands. It's quite interesting how that share price is performing, up about 5.5%, even though they said despite their cost-saving initiatives, they did see a high level of input cost inflation, and they're also expecting double-digit inflation in the second half. It's quite surprising, given the share price performance. You would think it'd be a little bit lower.
I think the key thing for Tiger Brands specifically is that a lot of the negative information has already been priced in. We saw the share price prior to today down 22% year to date. Not unusual for food producers. As you've mentioned, supply chain issues as well as high inflation has been a significant headwind for food producers, and Tiger Brands included. And so we've seen them try to ramp up on the working capital side by building up their stock and buying raw materials, trying to counter that prospect of further inflation. So that has had a negative impact on the operations, but specifically for Tiger Brands, also negative in terms of volumes, down significantly. But as I said, I think the key thing here is that a lot of the bad news has already been priced in, so we've seen a little bit of a bounce today.
We had Rhodes Food also echoing similar sentiments, especially when it comes to the pressures they're experiencing. In fact, even going further to say that their next focus is going to be recovering some of the increased input costs from the market. What did you make of their financials?
Yeah, so complete opposite to Tiger Brands, obviously very different sized businesses and different offerings. Having said that, they were able to grow volumes, and this was largely driven by the international operations. So we've seen a significant increase of about 53% on the international division. I think similarly to Tiger, what we're definitely going to see is an increase in pricing going forward and a squeeze on margins, unfortunately, due to rising costs. If you translate that to the food retailers, you'll see that there's going to be squeezing from both sides. And I say that because food retailers have managed to rein in their food inflation, internal food inflation over the last few months, ranging between 2.1 to about 4%. For the local food retailers. So food producers still going to have a rough time. And I think that's going to continue until the macroeconomic factors turn around in their favor.
Taking things stateside, we had Snap cutting their forecasts and also warning about the deteriorating macro conditions. That share price down 43%. What's your conviction on social media stocks in the US?
It's so volatile, number one. I think in a risk-off environment, a lot of people are looking for more value stocks where there is value. We've seen the S&P down significantly, about above 15% year to date. It's probably one of the worst performing across the globe. And so, unfortunately, there's a read-through from, as you mentioned, social media, but more importantly, e-commerce. A lot of it driven by customer sentiment and customer confidence. And unfortunately, what this does show is that based on customer transactions, which is the read-through for ad revenue for these platforms, we're seeing a pullback. And that gives us a sense of what is actually happening to the consumer globally.
All right, Carmen, let's leave it there. Thank you so much for your time. And as she did mention, we've got those FOMC minutes coming out later this evening. And then tomorrow, we are expecting US GDP figures, which we will unpack for you towards the end of the week as we do a stock take in terms of some of the key themes that played out. But that is it from me. We're going to take a quick break. And when we come back, we'll have more news for you.